My name is Max Gagliardi, and we're here live with co-host David Heikkinen for Talk Energy Insights on April 28th, 2022. Just got done with some earnings, Hike. You want to talk about it today?
Yeah, I'm just paying attention mainly to the gas stocks, and I paid attention to the services names last week, so we can talk a little bit about Schlumberger, Hal, and Baker. But really the thing that's been interesting is just watching natural gas, which is a group that I've been buying into for a bit post-retirement over the last month, and I think I'll keep doing it. Like, saw EQT today go through a full reversal, effectively trading off until their call started, and then, it's a buy the dip kind of day. And I just think there's this big margin expansion that's coming, both from, the liquids-rich names, exposure to natural gas liquids. I also think EQT's comments that turned them were direct exposure into the European gas market at TTF. And, for those that don't know, that's really the most liquid hub for gas trading in Europe. And sounds like their counterparty has some upside protection, and EQT has some downside protection. Most LNG contracts are usually, a NYMEX plus deal. And so they, as the largest gas producer, are really working on a way to get some direct exposure into Europe and doing that quickly. And obviously investors seem to like that today. Saw Antero, which is a stock that I do own. They came out and showed a 5-year plan that essentially they're in the next 5 years at the strip between now and 2026, buying back 90% of their market cap, or almost 75-80% of their enterprise value. Wow. And so, just the cash generating capacity for a company with a reserve life that is easily twice that, and using the PEP Insights years to peak production, probably 3 times that of sustainability of volumes. There's a reason to be a little bit favorable of, natural gas as a transition fuel, or just the world needs the carbon and hydrogen chemical bond, and that's probably the last ones that'll get burned. And then Southwestern just reported. I was just looking through it before here. It looks like the free cash flow is high. They basically said they'll be moving towards investment grade, and then I still think they're going to get into a share repurchase program in the back half of the year. And so, these aren't stock recommendations. I do own some Southwestern as well, but I think the gas side is still, just North American, and now moving into a global gas price is just simpler for me to get my head around, and it's still a bridge, regardless of how the climate fanatics want to go. And I'm a big believer in climate change. So I just think that it's going to be a bridge fuel that's necessary, and it gets you closer to hydrogen if you want to believe it, but it definitely feeds a lot of plastics manufacturing, feeds a lot of fertilizers as well. So there's a whole lot of reasons to have that bias. Only other thing that I thought was interesting, and we'll see Chevron and Exxon tomorrow. So I was looking at Pioneer, PXD, and they've been vertically integrated for a while. What's interesting about vertical integration for them that just stood out is they have their own sand mine, and that sand mine had some problems. And so a little bit of a hiccup into second quarter. So vertical integration to, a single or a couple link chain isn't necessarily as good as what I kind of would joke about, like that, when you get into that supply chain of, owning your own, but not having a whole lot of backup. It's not impacting their full year, but it's just something that I paid a little bit of attention to. But man, it's a cash is king kind of world in the energy space, best performing space in the S&P. I still think it's, trading with big free cash yields, going to last for a while, and is not overvalued. And you look at the pullbacks, it's just interesting. The story stocks in the market are going into valuation mode. I heard a comment today on CNBC about Zoom trading at 25 times earnings. A year ago, 2 years ago, nobody cared about that. No one talked about valuations for the tech companies, but they're now starting to. And if you start talking about tech valuations for them, you're going to have to look at the valuations for energy and say, this is a space that's going to actually do pretty well. So it's interesting times. I mean, it's I put out a comment about $12 gas next year. and now I'm not an expert on Russia, Ukraine, and Poland, but like it sure seems like Russia's starting to play the energy card to get rubles trading in the financial markets again, and that's only going to make things tighter. Saw some comments about you're watching Libya now, watching Algeria. Like there's just a lot of things that are leading towards just a geopolitical issues that are going to lead to higher price as well. So it's good stuff. I hope people are interested.
Yeah. I was going to say, it is interesting. I wish we would have had that one last week. We lost one for anybody that's tuning in again. We just had issues technically recording it. We didn't stream it, but this one we'll be able to capture. But go ahead, finish what you had there, Hike, and then I'll.
No, really. So now tomorrow, like we did see some of the working capital swings and, just kind of seasonality. And I was just going through the numbers on Southwestern. They even highlighted it. The big question now is going to be Exxon and Chevron tomorrow. And, what ends up happening? You saw Exxon declaring force majeure in Falkland because it's harder to market the crude associated with that LNG and natural gas. And so it's going to be interesting. That's a Russian project. And so that, we're starting to get into the question of, are we going to see barrels come off the market? The prices are holding in pretty well. It's way higher than what you need to get to any break-even economics. I wanted to ask you a couple questions as well. You'd posted a couple comments about it was more than triple-digit returns. I think it was four-digit returns.
That was from a finance guy in a meeting, but he said some of these are ridiculous. They're like 1,000% rate of return, which I don't know if that's true. He's probably just exaggerating, but I can tell you some of these gas wells that are liquids rich. The net back even after fees is, or at the time, that was the day when gas was really spiking up there to like the high sevens. Mm-hmm. And it was like pushing $10. Almost. I think it was just underneath because we went back and looked at the netback model. It was maybe like in the nines, something like that with the NGL value in there. And these are more like 1,200 BTU. Some of the stuff where you've got the higher BTU, I think you could be every bit of that 10 handle, and including NGLs at the wellhead. And I hadn't seen anything like that really since early in my career, and was in Oklahoma specifically. But then also the oil in this area was pretty good quality. They weren't really getting dinged, and it's been pretty competitive from the purchaser side because of the lack of barrels given where the market's been in the last couple years. You saw it go from like a no bid during COVID, and then to now production's fallen way off, and all these middlemen marketers as well as the refiners are really trying to get aggressive to get the market share from the wellhead barrels, the guys that are in that game. So really good for the producers, and that was probably exaggeration. Someone said, "Oh, you probably believed him," and I put the meme from X-Files. I said, "I want to believe," because I just want to hope that these guys are doing really well. I think they are, and so that's interesting. And I think your comments around the publics on the gas side are interesting as well. What are they going to do with this cash? It seems like returning it through share repurchases is a popular thing the investors are clamoring for. But I'm still in kind of disbelief at the strength of natural gas. The news with Russia shutting people off seemed to cause the spike here just recently. But it's just with the economics being that good, like what I mentioned, and given that there are oil field services constraints and rig constraints and these things, I get that. But that's just a lot of juice to not want to squeeze out from some of this acreage. I talked to a CEO today. It's a podcast that's going to release next week, and he was just like, "Yeah, we basically had 700,000 acres in this PDP that we picked up that was just an option." And he's like, now that option is very much in the money. And they didn't pay anything for it, So yeah. Guys that have, and so he's looking at probably like drill cos, JVs, et cetera, to get that production online potentially. But I guess it's like, we know there's a lot of discipline and a lot of share repurchases and things like that. But natural gas has to surge higher at some point in the U.S. and supply prices.
The thing is these gas companies, at least on the U.S. side, really were over levered, and right. So they're like some of the best self-help stories in the market, and the market loves the self-help stories on the oil side, and Oxy did phenomenally well year to date, and just kind of getting to the point where they're fixing themselves. And And that's what I think the gas side is doing. And what's interesting to me is I was looking at like where consensus is for commodity prices. The sell side has really driven oil prices up, but they haven't, narrowed that spread for NGL prices. Like they're still doing a low percentage of oil price, and that just isn't in the numbers. And then they're clearly not running the gas strip yet. Like I've seen people update prices to like $2.75 and $3 long term. It's like, come on now, guys and gals. Like y'all are maybe a little bit behind what's going on in the globalization of natural gas if you've been very North American centric. But like look at what EQT has been able to do with this TTF linked contract. Like I think that is something that's going to be important.
Right.
And that's something that was new today and new to a lot of people. And it reversed that stock pretty quickly. So we'll see. I mean, it's a long haul. Like I'm not trading. I'm buying and holding. Kind of the same thing I did with Bitcoin. I've traded around that more than I will these gas positions. But that is just a kind of a mindset shift. And what I just think is happening is from a global standpoint, the deflation story has stopped. Like we're not moving more jobs offshore. We're moving them onshore. We're not moving from lower wage areas. We're moving them back to higher age. Like we're adding back healthcare. Like materials and manufacturing are coming back. The insourcing of everything from critical earth minerals to actually having energy sources, and then finally, the externalities are coming into roost. And I do think that climate impact was an externality that was effectively the sell of the long tail has happened across all industries, and got to have something that's going to inflate, and the commodities give you that. And then if you also have an inflationary environment on the commodity side where you have estimates not including the expansion in value on what you're receiving for NGLs and nat gas, like that cash margin expansion is just going to be bigger than anybody expects. It's not as good a margin as oil is. I'm not saying that, but it is definitely a huge percentage change in cash margin that gets me excited.
Yeah, I had I've been trying to slow down on Twitter this month. I don't know if you saw I posted I'm down like 45% on the amount of tweets that I put out, which I feel like is a win. But I had one that was popular like last week, and it was basically saying, look, the industry was starved for capital by the ESG crew. And let's just face it, Larry Fink, he's done an about face. Like his 2020 letter was very, very clearly starve these people for capital. And that was like a mandate, basically. And so they did. Like a lot of, everybody keys off of BlackRock. And, I saw it firsthand we had investors at the time, and they said all their LPs, they want to be as far away as they can from oil and gas. And so I made the tweet that said, look, if, they're going to get starved from capital from investors, then they're going to get it from consumers. And that one seemed to resonate with people. And it's just a thought that I think you and I have talked about it, and it's just been kind of, going around in my brain because, for the last 10 years, I've been very focused on the capital side because a lot of smaller companies or mid-sized companies that get private equity or get institutional capital were a lot of the clients for my company. And so it was like, well, where are these, if that institutional capital dries up, then where are the new clients going to come from? Because there's these teams are struggling, or smaller and mid-sized companies are struggling. And then I had an aha moment in the last few months where I was like, well, wait a second, it doesn't really matter if there's any institutional capital. If cash flows are this high, guys are going to start spending money again. And then those will be where the customers come from. It's going to come organically.
When you saw it, Continental reported and had, I think it was a $350 million increase in capital. 100 to 150 of that was operated by others' capital. And so that's the smaller companies in Oklahoma and in North Dakota, and probably a small amount in the Permian that is operated by others. And, that is driving capital budgets up. It will be interesting to see that private equity side, those people that did deals with companies like Devon to pick up the OBO side, how quickly their money gets tapped. So I do think that those, preferential OBO operated by others or non-op drilling deals, are going to make a lot of money for people on the private side because you're picking up the economics at, this commodity price, and, it cycles in, the next 3, 4, 6 months. So it's going to be interesting. I really do think that increase in capital is coming. And you just saw it in Continental Resources this week. You mentioned one thing. So like you think about the revenues, like revenues are for egos and cash is, king essentially if you're running a company. I do think that this question of like the externalities of Twitter, it's kind of a strange thing, and we don't have to get into it here, but at some point I'm just curious, like what good does it do to drag someone else down, as opposed to just trying to build other people up? And, that's been my mindset. And I got the sarcastic shirt on if I'm silently correcting your grammar. Well, yeah. I do that all the time whenever I read tweets. And I wish that I could respond, because I do have that itch of 22 years of editing other people's stuff that has a scratch. But the idea of that is trying to help people get better. And I do think that is one thing that I've liked about FinTwit and the EFT community. But people have been attacking you, and I just don't understand the logic of it, like what good it does. And I feel bad whenever I read those things. So I just wanted to say something about it.
Yeah, it's an interesting thought. I think that, we've talked about this idea between, I'll kind of pare it back and relate it to the podcast around, ideas for guests. And we say, okay, there's like internet people and there's real life people, and there's people, and then there's some people that are both. And I think the dynamite is when you can find a guest or get somebody on that has these credentials that are real life credentials, but they also have a media, social presence. And those are great guests because they have distribution, plus they have, the chops to back it up, and they can really, talk through these things. I mean, I don't know, man. I think honestly, and I say that because the reason why I got into this stuff was because my brother really pushed me. He had a podcast and he was really early on in his career. And so he was like, hey, and he was just like trying to make a name for himself. Like, hey, I want to do this to network, and I want to do this to get out there. He's like, I don't have the real world experience. And so he was like, you should do this. You should get out there and put yourself out there, because you do have the real world experience. You have done things. You have, built companies and been an entrepreneur and do these things. And he's like, and you're not using any technology or any media at all. And he's like, and I think that you would enjoy it because you like having good conversations. And so I think that putting yourself out there, especially if you're somebody that's doing real things, you just have a target. I mean, people are going to attack, if you're somebody who's doing nothing and you're an anon and you're in a cube somewhere, then you can tweet and do whatever. And it just is who cares? Because no one really knows. No offense to those people. I'm just saying it's just a different profile. Right. And so I don't know, man. I just think that at the end of the day, it's kind of what you sign up for. It's if you look at any profile that's active in social media, you're just going to see all this crap getting hurled at them. And it really hasn't bothered me at all. Sometimes it just gets really bizarre on here. And in fact, I just did an Origins episode with my brother, kind of directly related.
I saw that.
And it's a part 1, and then the part 2 is going to be more about my professional stuff. It's because I just see this stuff that's just fake all the time on social media, and then people then start propagating it. Oh, did you hear about this guy? Blah, blah, blah. And I'm like, this is bizarre. And then people that know me will call me and be like, did you see this? This is crazy. And I'm like, yeah, I know, dude. It's weird. So you just got a lot of people on here that I don't think that they have a lot going on, because they're obviously on Twitter a lot. And then they somehow, it's kind of my wife says it's the person who's behind the wheel of a car, except it's the internet version, right? They have all this rage and they think that people can't see them because there's the windshield there. And it's no, we can see you. You're being crazy. And that's how Twitter is. It's they think that, they're somehow anonymous or whatever. And it's no, people actually are alarmed, you're just doing crazy things. So I don't know, man.
It's kind of one of those things. I think Colin at Digital Wildcatters made a comment of, you kind of have 40% of the people won't like you, 40% will, and 20 won't care, or 20 will like you. Just have to choose what percentage splits you want, and but you can't make everybody happy. And that's the one thing that I also find is, whenever I don't know something, I say I don't know, which is unusual, I think, and only talk about the things that I know something about. And so it is an interesting time. Where I am right now, I spend most of my time, flying airplanes and pressure washing, and then I just come into the markets for about half an hour a day to see what's happening very quickly. I really don't read anybody's research either. I don't know why. I probably ought to get on some lists. So if anybody has great ideas of research that they read, I'm going to use this as just send me a message or post it. I'm keenly interested in trying to see if there's a good news feed and curating my things that I'm following to narrow them down to people that are trying to build things up and communicate real information as opposed to not. So
yeah. Well,
to
end this segment, I was gonna say to end this segment out because we can get back to the energy stuff here in a minute. Because I got a few more things on the earlier segment that I want to go into. But what I will say is that I do think the positives can outweigh the negatives if curated in the right way. And some of the negatives aren't even just the things that people say or do that are ridiculous. Some of the negatives are just like spending too much time on this stuff, not being mindful, following stuff that's garbage. I mean, a big part of me, like starting this account and kind of starting with a clean slate and being like, what am I actually going to allow in, right? Like, what do I want to allow in? And then not being afraid to be serious about what you curate and try to find things that add value to you, whether that's like energy stuff, investing stuff, whether it's lifestyle things that you enjoy, fitness, exercise, whatever. People find different things to follow. So I think that it has a lot of power. Then the other thing is like getting the message out. And I think that there's a ton of positives there. So like, I don't want to be negative on it. I think that the bad will be there, but I think it can be and should be more positive than negative. And so pivoting from that, because I know people are listening for the energy side of it. Back on natural gas, what I will say again is that it's just, to me, the most interesting thing right now in the energy space. Oil, it's interesting. It was getting really crazy there. Maybe it'll get crazy again. I kind of feel like the big question mark for oil especially is going to be like the economic numbers printed today. Like, are we going into a recession? Are we already in one? Is this the dark horse that can throw a wrench in kind of everybody's forecast and what we think is going to happen here on the energy side? Or is it doesn't matter because it's a supply side thing and it's not a demand side thing? I don't know. Just your thoughts around like economic growth and where things are going.
It's a strange question so oil trades down in the near term because of China and lockdowns, but at some point China has to come out of lockdowns. And so there's this, if they have the same variants that we have had in, Europe and America, they're not that bad. And so like you ought to come out and actually, have a lot of growth then on the other side. And so it's kind of like the SPR release, it's negative in the near term, longer term positive. And so I keep thinking about that from the demand side, but higher prices, every time I fill up with gas, I look at every one of the pumps and there's a lot of round numbers. Whenever I see like the $8 fill up, I'm just like, dang, man, I remember what that was like. Like, it's not a good time to put less than 2 gallons of gas in your car. And that happens more often than not. I've been driving around a little bit more in the last month. So I think that we're seeing some of that economic hit and like this higher price across the board. Like I said at the beginning, deflation has stopped and we're in an inflationary environment. And that has to impact kind of how people spend. The real deal is you still have to get to and from work and you still have to, have electricity and you have to power and warm and cool your house. And so, or your residence or where you're working. And so it's the energy side again, feels like, if you're running inflation on both sides, it's one of the more resilient spots. But, oil is not something globally that I've thought a whole lot about just because I own a little bit of the majors. I think all of my energy holdings before March 31st were in a blind trust. So I didn't actually know what I owned for about the last 15 years. And it was interesting seeing what I own. I don't need to say everything, but the names that I have talked about that I've bought recently are the gassier side. Thinking a whole lot about carbon right now. But I think that that's more the carbon markets, not the stocks that are exposed to it. But I'm not doing anything actively there.
Yeah. Yeah. I don't know. I mean, to me, that's kind of the looming question mark. And to your point, I mean, even if there is a recession, it's like, okay, is that really going to cause people to drive less to work? Maybe travel takes a hit. I mean, I don't know. People are a lot of pent up demand there. People are wanting to go places.
Have you tried to book any travel this summer? Like my son did a big research. I got to give Charlie some credit. Like he sent probably a 4-page email on how we could get to London most effectively and hotels and things we could do. It was a big ticket. Like there's 5 of us.
It's
and
huge.
It was like, holy mackerel.
Yeah. I mean, we were trying to go to like, we had a wedding it's kind of a funny story. I'll just tell it. But my cousin had a wedding, and it's like I don't go back up. My dad's from Pittsburgh, and I don't go east up air, as they say, very much anymore. So I thought, okay, we'll take the family, and it was gonna be like a $6,000, $7,000 trip. It was something crazy to fly like 5 people, get an Airbnb because we have so many people, and then like rent a car and do all the things we had to do. Then we found out that the kids weren't invited to the wedding, and I was like, yeah, actually, we're not going to go. I was like, we're going to go to like, I think we're going to go to like the beach somewhere instead. I'm sorry. I went and saw my cousin for his bachelor party, and I was like, this is the time we're going to hang out.
Apologies to your cousin. Like not that you didn't want to go. It's just that your Rugrats weren't invited.
Like, so you've ever been to Pittsburgh?
You were planning on bringing it all.
Right. It's cool. It's not like $6,000 cool. It's like, it's nice, but it's fun. It's good to see family. But no, I mean, I think like the travel demand will be there. I just worry. I mean, that's just like the biggest thing to me that's looming out there is just this idea that the economy, just the macro right now is nuts. Like, I don't know. You have a lot more experience. I mean, you're older than I am, and you've looked at the markets more than me, but like just your thoughts on the macro generally, then how that plays in with energy.
So I tend to still think in valuation and individual stocks. Okay. So I'm not a macro investor by any way, shape, or form. Other than, the only thing that I think about is like, where are the things that are solving big picture problems? And then like, are the right people or right assets solving them? And if they're not, then you shouldn't own it. And so like those things that are disruptive at scale, which are the Amazons of the world, are still disruptive at scale. Like there are some things like that stand. Microsoft still is, like those massive and mass scale, but otherwise I get very, very micro, and just try to figure out where the numbers are and what's cheaper and where there's gaps. And that's been my whole thought process for a very long time.
Yeah.
Macro investors are like economists. Like they never actually make a call. And then it's like, oh, well, if this happens, then that happens. And so it's like, that doesn't do me any good. Tell me if the stock is going up or down. Has been my mindset. And then you're going to live and die by it.
Yep. I hear you. Well, anybody got any? I think we could open it up to questions. We're at like 30 minutes here. I've got to bounce at 5. Anybody want to come up? We can, and I'll leave it open. And then if someone raises their hand, we'll pull them up. But no, I'm actually the opposite of you, Hike. I kind of never been a big individual stock guy. I've always been more interested, I think, in the macro and how things tie together. Everything going on right now with interest rates, very, very interesting to me. Have not seen it move this violently upwards, and we'll see what that does.
I'll say one thing that shocked me this morning. Just happened to walk by, and the Today Show was on, and they talked about buying savings bonds. Like I legitimately can't remember someone buying like a regular government savings bond, talking about like 9% since the 80s. So that was an interesting tidbit of like, Savannah Guthrie, I think, even said it. So I was like, whoa, wait a second. That's my macro comment for the call. Don't watch the Today Show for investment advice, and beware of Twitter Spaces as well, because it can get you in trouble.
Yeah, but definitely.
My value as an investor degrades every day that goes beyond me leaving the sell side. So I'm just getting more and more focused. I'm trying to be less and specific about the things that I own is the fun part.
Well, back to the earnings stuff. I mean, was it what were like on the ones you talked about earlier? Was it expectations? Did they beat? What were any of the surprises, if any? I mean, I know you mentioned like the EQT thing with the European pricing benchmark, but anything else you thought was noteworthy?
Okay, I think we're seeing the working capital swings on balance sheets. So that is hitting, what amount of cash build you had, which then directly impacts what amount of cash, can be returned quickly. And so that kind of coiling of the spring of where working capital was seasonally, you're getting to the point where, that spring is getting compressed, and then it's going to spring out on the share repo or debt reduction, dividend increases and the like. So that has definitely happened through first quarter. I think, a little higher differentials. It was an interesting range, threw some shade at the Haynesville, given the Southwestern's bought a lot down there. That was just interesting as you kind of think about the people at these companies and who they're talking to on their calls. You know who they're directing their comments to. Chesapeake and Southwestern very clearly would be the companies that are the buyers. So it's just interesting, those little curves of personality. All these companies are still just people. So knowing them and kind of understanding, some of the goods and bads is kind of amusing to me.
You're like in tight with all these CFOs. You're always like, oh, I talked to this CFO. Oh, I just was at lunch with that CFO of all these public companies. So
it's a little weird.
These guys and gals.
And gals, and I think we have to say y'all. Like that's the safest term. I was actually on a call with some people in California, and it was mostly ladies. And I think I said that, and I was corrected soon after. So I'm only going to use y'all. Because it is non-gender specific, and it's just safe. So
never thought of it
other than
like
the
that.
Southern connotation.
Never thought of it like
y'all.
that. But
thanks y'all for being on this Twitter.
Yeah. What about balance sheets? What about balance sheets? You mentioned it earlier. Like, what would be the nearest term comparison versus historically?
The key thing. I mean, these companies going back 2 years were 4 to 6 times levered on, multiple of debt to EBITDA. And now the target is less than 1. Wow. So it's effectively an under-levered enterprise. Like the large companies, the Conocos and EOGs of the world are negatively levered, from a reality standpoint. And that's not effective gearing, candidly, unless you believe the tail for oil is 0, within your leverage profile. So, we're an underlevered group, which gives them, the valley of death of just 2 years ago. I mean, we're talking about 2 years and 8 days ago, oil traded negative. That scar is still very keenly in my memory. And it has to be in the memory of every board member and every manager and everybody in the energy space, candidly. And so that's not that long ago, but a year from now, you're going to be in a really, really strong position. And I think that you'll see, overall market caps, either the share price is going to go up as the share count goes down. But no matter what, as you're a shareholder, you're going to own a higher percentage of the public float a year from now than you do today, even without buying more, because they're going to be buying them in. The thing that's odd, and if you just think about where the world is going around hydrocarbons, and I think it was, who went through this thought process? I'll find out and I'll post to you, or I'll put a tweet out, but the publicly traded barrels or the publicly traded hydrocarbons are declining dramatically. Like, just think about what the majors are divesting and who they're divesting to. Mm-hmm. And then think about who's growing. It's private companies and private equity companies. And so like the direct exposure to hydrocarbons, globally as a percentage of total production is declining. And so like the companies that are public that actually have that exposure have an inherent value appreciation because there's a scarcity factor of publicly traded barrels and publicly traded MCFs. And I was like, man, that's a very long dated thought. And I think he and she were right. And I'm trying to remember who it was that had that perspective, but it's totally true. And so if you own a publicly traded hydrocarbon business that has stability and longevity, like from a global standpoint, I mean, we're going to be 100+ million barrels a day of demand, going probably increasing, and our gas demand is definitely going to increase. And so like, if you own those public shares, your share of the global enterprise, if the rest of the world wants to buy something publicly, is going to go up in value because of scarcity factor. And I thought that was an interesting perspective for those of you that think about scarcity of an access to that investment. It's clearly there in the public markets because, like you said, the BlackRocks of the world don't want to put more capital in. And so like, if you're buying into a space that I believe needs to have support and the world's going to keep demanding the commodities, the publicly traded, barrels and MCF is something you want to have exposure to. And then it's just buying the right assets and management teams and, just hold on, because I think it's a long dated trend that, I think is interesting and not talked about very much.
No, it's really interesting. It's a theme that I hadn't heard much about, and it makes sense. And I've seen it. kind of real time. And I wonder what that, I feel like the private guys have more running room now. I mean, all the private guys I know, and I can talk to this a little bit because this is more my world. I'm not a public equities guy, but the private people I know are trying to get after it right now. If they can,
Mm-hmm.
I mean, they want to. I mean, everybody, I mean, we got, 2-3 person type companies, like small companies, just a handful of guys with some private money that are trying to pick up, multiple rigs. Like they want to run 2 rigs, So like, I
Yeah.
know anybody that's private that has the experience and has access to an asset that feels like it's good rock, they're trying to make hay while the sun shines. So I don't know what that part of the wedge is. I mean, I'm assuming it's a smaller. I mean, do you have any sense of that? Because you guys look at the total
Well,
production numbers, but
I used to have that at my fingertips. I could probably find it or get it relatively quickly, but off the top of my head, I'm not sure. What I was thinking about though was, think about the global divestments of the majors. Like think about the IOCs that are
right,
non-public that are controlling a lot of volume. Like if you want public exposure to hydrocarbons, it's kind of these North American companies that have some stability, and so they're getting larger, and so it's just that was how I thought about it, like a global
gotcha.
share of all all BTUs produced from a fossil standpoint. The public share of that is declining, and because of that is a scarce opportunity to invest, and that's something. Investing in places that there's scarcity tends to be an opportunity for appreciation if you believe in the underlying value of what is going to be scarce. And I think natural gas has some real floor to it. So
Yeah,
kind of like your Bitcoin people who believe in 21 million Bitcoin ever will be out there. It's by definition a scarce asset. Well, if more public capital isn't going into hydrocarbons, by definition, it's going to be more scarce for public investors. And then if the public companies are buying in their shares as well, they're by definition making them more scarce as well. And so you have this benefit on both sides. And then you have U.S. as the most stable market in the world, as we're seeing with Russia and Ukraine. And, we can get into the dollar and all that yada yadas, but that seems very macro. I like this scarcity of public barrels and MCF is a new trend that I think people need to talk more about.
all right, we hit on a few names. I love that. That's great. We could get into that more. But you talked about it earlier. There wasn't nearly as many people on the call. Who do you like? That we.
Oh yeah, sorry.
Today. Who do you
We
like?
started us out. I'll just recap. Yeah, let's do a quick recap since everybody was on. So through earnings, one of the things that we talked about at the beginning was, natural gas and natural gas liquids companies tend to be the self-help stories. You saw EQT today go through, buy the dip, and really I think it was on their LNG exposure to European gas prices, versus most of the LNG deals in the U.S. are NYMEX plus deals. There's this real opportunity where ethane and liquids-rich names, the NGL names, are going to see big cash margin expansion. And, we kind of hit on, so I don't own EQT. I do own Antero, Southwestern, and Chesapeake on this exposure, and Antero's already reported. Southwestern just did after the close. The thing on Antero that I hit was they're buying. They can buy back 90% of their market cap with their 5-year free cash flows, and buy back 75% of their enterprise value. And so, and those are on numbers that are not necessarily a strip for NGLs at a percent of where TI is, or even the gas strip is in that. And I just think that there's these self-help names that are going to get way better, and we talked a lot about that. And then we'll see what Chevron and Exxon say tomorrow. It'll be interesting to see their working capital swings and how they talk about Russia. I think it's going to continue to be telling to see Exxon's force majeure on Falkland, like just what they actually say on this divestment, because again, any divestment there is probably not going to go to a public company, which feeds into that, less public barrels and less public MCFs are available for, people like you and me to buy in the public markets. So that's what we talked about.
Yeah, it's good stuff. Well, we didn't get any questions, which was random this time, but we are butting
That's
up.
all right.
It's all right. Sometimes these questions are hit or miss. Thank you guys for tuning in.
Right.
We try to do these. We were once a week for almost a year. We've missed a few weeks lately, but we did one last week and we didn't hit record. It was really disappointing because we had a good guest and it was a great spaces. But record this one. It'll be posted on the podcast app. It's Talk Energy Podcast. It's on all the major podcast platforms. Follow David Heikkinen here at Hike Energy. You can follow me as well if you'd like. And we've got try to get content out once to twice a week, typically twice a week. A wide range of guests. Appreciate you guys. And we'll hopefully see a bunch of you guys here soon. All right.
I'm chill. Have a good one.